Our next guest writes that easing inflation and a cooling labor market have sparked optimism of a soft economic landing. But he says there are four things standing in the way of that. Joining us right now is Nick Timiraos. He is the chief economics correspondent at the Wall Street Journal. When he writes things, people read it. They listen because he has been very right on the Fed for very long. Nick, I think you concerned a lot of people recently when you said that, a soft landing always looks like that at the beginning, but it's really hard to really nail that. And it's something that's pretty elusive. What got you to this point? Why are you writing about this now?
Well, you look back at this point in the cycle when people think the Fed is done or close to done raising interest rates. The economy looks okay. You don't quite know yet if the Fed has done enough to put it into a downturn. And so there's a lot of optimism about a soft landing. It's like a Hail Mary football pass, right? When the ball's in the air, a lot has to go right and a lot can go wrong for the receiver to take that ball in the end zone. But you think maybe this time it's going to work out. And so I think that's where we are right now. And the piece was just sort of a way to look at what are some of the things that have to go right and what could go wrong here. I mean, what could go wrong is that inflation could pick back up, growth could reaccelerate, and you could have more concern about reacceleration. On the other hand, the Fed could be the obstacle to the soft landing in that they're saying they want to stay higher for longer, Becky, and so that means maybe not easing as quickly. And if you look back at the few examples that we have of those successful soft landing, Hail Mary receptions, the Fed was cutting interest rates and taking back some of the increases they had done. So I think those are the two main concerns here.
Hey, Nick, don't look now, but when people say Volcker, or when people say, remember what happened back in the old days when we went to 21.5%. It's different this time, people say, because, well, we don't have the oil shock that we hit. And then all of a sudden, wait a second. And they say, well, we don't have the wage price spiral. We don't have unions emboldened and asking for, well, wait a minute. I mean, suddenly some of these things are starting to look a little scary. And you remember the stop-start nature of the Fed back then before Volcker, which allowed it. It never put it to bed. It never got the stake in the heart of inflation. And he had to come in and go crazy. I mean, it's starting to look maybe like it's not quite as different as we thought it was from back in the 70s and 80s.
Well, I think that's a great point you raised with stop-go, because it speaks to the importance of luck in some of this. Of course, you can make your own luck. But look at Volcker. In 1982, inflation was still above 4% when he sort of called the dogs off and said, all right, that's enough. He abandoned the, monetary aggregate targeting that they had put in place because he thought he had done enough, even though inflation, it wasn't, all the way back to zero, right? And then they had to start hiking again in 1983. So you could say, well, was that stop-go? Obviously, they got help from the supply side as things went on there. And so I think that is important. What happens in the developments that are outside of the Fed's control could play a role here in whether we get kind of a mild recession, soft landing, whatever you want to call it.
Because no one's saying 8%, much less 9, 10, 11. I mean, we're saying another quarter point, worst case scenario.
Well, I mean, look at where we've gone on inflation. I mean, we've now had, next week, we'll probably see a third very mild core inflation reading. You'll be looking at 2.5% core PCE inflation on a 3-month annualized basis. So it's hard at this point to compare this to the 1970s or 80s.
So your analysis at this point, is this an argument for the Fed to kind of stand pat and wait, look around, see what happens?
I think so. I think the question here is, if you cause a recession here and you're the Fed chair, you're Jay Powell, is someone going to thank you for causing a recession because inflation was high 12 months ago? Right? A year ago, you look at where we were, 8% inflation.
Too.
Well, no, I mean, we had had a lot of years of very high inflation. So people eulogize Volcker today because he fixed what had been a years-long problem. And if we have 2 years of high inflation and now we're looking at, 3% next year, that's different from what we faced in 1979 or 1980.
Nick, I'll ask you a couple quick questions. First of all, what's your gut tell you? Do you think that the Fed is going to keep rates higher for longer? Because there are a lot of market participants who aren't really agreeing with that, who think it's going to come, rate cuts will come as soon as the end of this year, even early next year.
It's impossible to tell. I mean, you tell me what's going to happen in the economy. Look at what happened in March. Powell puts 50 basis point hike on the table, and then we have a regional bank ruckus, maybe not a full-blown crisis a few days later. So it's impossible to tell. But what I would say is, if you look back, Becky, at where we've been over this cycle with the Fed always kind of on a different page from the market, that's changed since July. The tightening that you've seen, the long end rising, the market expectations now much closer to what we're going to probably see in the dot plot at 2 p.m., that's different. That's really the first time we've seen the market and the Fed really on the same side here about, when you hit the peak rate, but how long you hold. And so that provides a little bit more tightening of financial conditions, which is what the Fed wants to see. I mean, just this morning, 7.3% 30-year mortgage rate. We've now held mortgage rates above 7% for several weeks. We haven't done that, before August. So,
right.
So this is a different environment.
The other thing I'll say is we keep talking about it as if the interest rates are their only tool. It's kind of like thinking that this is an automatic car. This is really more of a manual driving situation, because you've also got quantitative tightening. We never talk about that. It's another tool they can use. Which do you think they'd be more likely to ease up with first? Would it be interest rates or quantitative tightening? How do they play that out?
They have been pretty clear on this. They want the interest rate tool to be the tool that is their primary, weapon here. So what I think they really want to avoid is having people like you and me sitting here before every Fed meeting saying, what are they going to do with the Fed funds rate and what are they going to do with the balance sheet? Of course, Jay Powell got in trouble at the end of 2018 when he said it was on autopilot. People didn't like that. But, let's use a different term. It's on cruise control. They don't want people sitting there thinking, what are they going to do with this tool and what are they going to do with that tool? Now, of course, at some point, they'll have to have a conversation about, are they at scarce reserves or less ample, whatever the term is, in reserves. But with an $8.1 trillion balance sheet, we're probably not there yet.